see that in the volatility of VIX itself. I always find that to be a little bit of a brain cramp, but the volatility of VIX, the VVIX, is still quite sticky, and it's telling you that underneath the surface, people are still worried. Yes, this is great, but they're not getting rid of their hedges quite yet. You're just saying that it hurts you to think about it, to be nice to us. Because you totally are comfortable with thinking about it. I wanted to ask about bond market volatility. We had Gabriela Santos on from JP Morgan the other day, and her most recent note was called, I think, Normalization Nation, right? Okay. Because everything's normalizing is the idea when you look at the labor market, when you look at rates and growth. But the bond market volatility is not normalizing. Why do you think that is? Yeah, look, and I think this speaks to what we had been talking about earlier, which is the nervousness you see in one versus the nervousness you see in the other. And, you know, eventually somebody has to be right. And I do think when you look at equity markets, when you look at reactions, equity markets tend to be more knee-jerk, first of all, and they tend to be more momentum-driven. So one ratio we like to track is just simply move to VIX, and that just gives you treasury vol relative to equity volatility. And if we start to see that peak a lot in favor of rates volatility, usually that means VIX volatility does need to catch up. So we're going to be watching that ratio. I want to talk about an area where there's some positive momentum. The small cap index, Russell 2000 today, gaining more than the S&P 500 at the moment. How much optimism is there across the street for small caps now that we're seeing these rate cuts? So I'll tell you, the trade that's been occurring for a while, this is even prior to the 50 basis points, was folks have been owning IWM call spread. So IWM being a proxy for your value small cap trade, and call spreads essentially saying, I want a high payout leveraged upside trade. To me, this is an upside hedge on the market. So if we're actually in this wonderful scenario, if everything is good, historically that means everyone's going into this widening breadth trade. Now, most folks, I will tell you, are still in the Mag 7, but they need to sit on something that works if the rotation happens very quickly. So we're seeing in IWM call spreads. Watch those small caps. Yeah. Too bad Katie's not here. And it's great having you on. I learned so much when you join us, honestly. So it's really cool that you can explain it to even a numbskull like me. Amy Wu Silverman there, RBC Capital, head of derivatives strategy. Coming up, Prospect Capital gets a negative rating outlook by S&P Global, citing one of the private credit firm's most used debt strategies. That's next in our Wall Street beat. This is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
And it's
It's time now for the Wall Street Beat. S&P Global has revised its rating outlook for an $8 billion private credit fund, Prospect Capital, to negative, citing frequent use of payment-in-kind arrangements. Of course, these PIK payments have become very popular on Wall Street lately. Prospect saw $417 million in realized losses for the year ending June 30th. Let's discuss this with Bloomberg's Sridhar Natarajan. This story, if you've been watching it closely, has been pretty interesting. But let's just talk about the wider ramifications quickly. Some of those losses tied to a single investment which filed for bankruptcy. We're seeing more bankruptcies. Is private credit in more trouble than it seems right now based on what we see with Prospect?
And you're absolutely right. We need to zoom out. Private credit went from an area of interest to hype to hysteria. Now the question is, does that hysteria tip over into greed and therefore generate bad outcomes? That is the real concern here. And that is why when we see developments with funds like Prospect, that's where we want to zoom into and see where the real problems exist. Because a lot of these funds are now funding middle America, the mid-sized companies, the smaller companies that banks are not lending to. Do we have enough of visibility into that space? And will that stay steady if there is an adverse credit cycle?
I was wondering if the Fed cutting rates will sort of tamp down some of that hysteria. But more importantly, I now want to know,
rate, right? It's kind of
what
awkward.
the hell is a payment-in-kind transaction? Let's not just gloss that over as if everybody understands, because I don't think
And why have they become so popular
anyone
right now?
besides you and Shonali gets it, right?
It is a beauty of financial engineering, right? You've gone through a phase where a lot of these companies have borrowed money. They have to pay regular interest on that debt. Now, sometimes they don't have that cash on hand.
So let's talk about one. Here's a question that's near and dear to your heart. You have a lot of children.
Yes. I'm trying to set a
The
good
birth
example.
rate is down in the U.S. What needs to change so people start having more children?
Yeah, so this question has troubled me for a long time, because you can look at the demographics. It's a very slow-moving ship. I mean, you know who's going to be an adult in 20 years based on who was born last year. So, if you want to, I think, have a good approximation for population, really look at how many babies were born last year in a particular country, multiply that by life expectancy. That's the number of people that will be adults in that country. That's the steady state population if birth rate remains constant. Now, birth rate is not constant, it is dropping. So you look at the second derivative of birth rate, and actually we see an acceleration in the drop in the fertility rate. Second derivative of the fertility rate is very bad. So where does this lead? This does not lead to a greater civilization. This leads to a civilization that potentially dies not with a bang, but with a whimper in adult diapers. That is a sad ending.
So obviously we have countries that, like Korea, used to have a birth rate of 6. It's now 3/4.
Yeah.
Here's a light question for you. What do you
come pick
think
me
are
up,
the
I'll
biggest?
give you a baby, says one
What
of
do you
the-
think are the?
That is one of the things that says on the screen.
Yeah. I don't know if everyone heard that. You want to read it?
It says, Elon, come pick me up, I'll give you a baby. Thank you.
Okay.
Well, I mean, I certainly encourage everyone in this room to have at least 3 children. Look, baby's got to come from somewhere, you know. I think we just want to have, I don't know, I think we want to have like a slightly increasing population, not a plummeting population. You know, and I think this applies to all countries and cultures. Like, I don't think we want any country or culture to disappear. We want them to ideally flourish and not disappear. So, in fact, one of the things that is overlooked by probably most historians is the role of low birth rate in the decline of civilizations. So around, I think it was around 50 BC, Rome passed a bill to give a bonus to any Roman citizen that would have a 3rd child. So this was a birth rate was a problem in Rome in 50 BC. The Romans weren't making Romans. The same is true of ancient Greece. So there was a time from about 800 BC to 300-ish BC where the Greeks had a lot of kids and a lot of surviving kids. Like the birth rate far exceeded the death rate, which is why you had Greek cities popping up all over the Mediterranean. But then I think basically it seems to be that prosperity destroys the birth rate. So when a civilization feels like it has no meaningful external threat and is very prosperous, that is what causes the birth rate to plummet. Somewhat counterintuitively, you think, well, if you've got more resources, surely that would lead to more kids. In fact, it is the opposite. The more prosperous a civilization, and the more a civilization feels that it does not need to defend against external threats, the lower the birth rate.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Brokers studio in New York City to our worldwide audience. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Podcast there. Big moves higher today in the markets in response, maybe a delayed response, I guess, to the Fed cutting rates yesterday. We'll break it down with Hugh Worthington, Bloomberg Intelligence European rate strategist. He can talk to us about the B of E. Michael McKee, he runs all of our economics here at Bloomberg. He can talk to us about the Dow, about the Federal Reserve. Tracy Campbell, Executive Vice President of Sustainability and Corporate Affairs at LyondellBasell for Climate Week. She's going to be in our studio to talk about that. And we'll take a look at the market's outlook from one Emily Rowland, Co-Chief Investment Strategist for John Hancock Investment Management. So we got to break down the markets, break down the Fed, and take a look at some Bloomberg Intelligence research. That's all coming up in the next couple of hours. Right now, let's kick it off with Mr. John Tucker, Bloomberg Business Flash.
All right, lower rates tend to favor technology. Looking at the major averages right now, Dow Jones Industrial Average, S&P 500 surpassing their record closing levels. You have 8 of the 11 major industry groups in the S&P 500 higher right now. Information technology in the lead. Some of the individual stocks on the move. Darden Restaurants, best performing individual stock in the index. That was up about 6.5%. The owner of Olive Garden announcing a delivery partnership with Uber. Sales, they also said, continue to improve. Now that it's a 50 basis point hike, Paul Donovan, global chief economist at UBS, says, you know what, the Fed jumbo rate cut isn't the result of any sort of panic over the economy.
There wasn't really an overwhelming conviction to go for 50. So I think Powell just sort of pushed in that direction, and it's not really signaling that there's anything wrong with the wider economy.
Right now, the S&P 500, 85 points higher, up 1.5%, 57.03. The record to beat there for the S&P 500, 56.67. So on an intraday basis, beating that already. Dow Jones Industrial Average, that's surpassing its record close of 492 points, up 1.2%, 42,002. swishing back and forth here. The NASDAQ 100 right now up 43 points, 433 points. That's a rise of 2.25%. As for yields, the 2-year, 1 basis point lower, 360 right now. The 10-year is up 3 basis points. That is at 373. Job market remains healthy despite a slowdown on hiring. Applications for unemployment benefits falling to the lowest level since May. And we check the markets for you all day long. Right here on Bloomberg Radio, I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
Hello.
Hello.
Good morning. Happy Friday Eve. This is where we're at right now. I'm Alex Deal alongside John Tucker and Paul Sweeney. So 50, did you have that on your bingo card, guys?
I did not, but that's, it's interesting. The market yesterday, after the announcement, didn't really do a whole lot. Just
I know.
Hung around, and then I guess people slept on it, woke up and said, hey, this is good news.
Also want to point out, it is options expiration tomorrow. It's one of the largest that we've seen. So there's a lot of reshuffling to get your correct exposure, and you're hedging right into all of that. Just pointing that out there.
Really big. Is it still?
Yeah.
Okay. All right.
It is. It is. It is for flows, right? Like, and also, like, is this actual real buying because we're really excited about 50 basis points, or is this you got to rejigger your portfolio and sort of your index based on all of that? Anyway, yep. Either way, we'll take it. Then what it means for the broader stocks and for the broader economy. So let's get to market. Let's get more on some of the details here. Market Drivers is brought to you by Interactive Brokers, a portfolio and analyst. Consolidate and analyze all your financial accounts on one powerful dashboard for free. Sign up for Portfolio Analyst at ibkr.com/free-PA. And let's get right to Norma Melinda, who's combing through all the equity moves. I'm just going to kick you off with home builders for a sec, because we got that existing home sale number. That came in weak. I don't think this is enough for Paul to refi. You're clearly going to be watching these guys, though.
I mean, I'm always keeping an eye on home builders, and I think right now, especially with this rate cut that we're seeing that was 50 basis points, and as we look further into the year, everyone's really going to be watching to see whether or not the housing market will finally unlock. Will Paul be able to refinance? Will I be able to get a house? The world may never know. But hopefully we find out soon. I'm looking at an index of home builders that's S15 Home, up as much as 2% today. And of course, we are seeing more of a broader risk on move. I'm seeing information technology as the best performing sector in the market right now. But as I'm looking at individual stock moves, I'm also watching Darden Restaurants. That's surging as much as 9%. That's the best day since September of 2021. And as John mentioned, this is really the owner of Longhorn Steakhouse, Capitol Grill, if you guys have been to that steakhouse.
Oh, yeah.
Really nice. Olive Garden, I don't really frequent there anymore, but apparently some people do, and they actually are having packs with Uber. They'll be the first to pilot that program, and it's hoping to really attract younger audiences there. So we are seeing shares up 4% year to date, so not too much here, but we are seeing a bit of a pickup today as we're watching Darden stock.
What else are you looking at?
I'm also keeping an eye on AT&T. Now, this is lower, down as much as 2.5% last time I checked. And this is after a Wall Street Journal report said that the company agreed to remove 8 miles of lead-covered cables from Lake Tahoe. And if you guys remember last year, the Wall Street Journal had really been conducting this investigation about a lot of the larger telecom companies like Verizon and them having their cables really caught up in areas that were actually affecting people in the area. Well, apparently, AT&T didn't really do much to improve the situation after these investigations, and they've been getting some more pressure from environmental groups, and this is finally causing AT&T to say that they're going to go ahead and remove the lead from in their cables and figure everything out in terms of Lake Tahoe there.
All right. Thanks so much, Nor. We really appreciate it. Norm Melinda joining us there with all the market drivers that you need to know. So I don't know if you guys made it, but, it was also BOE today.
Yes.
Yes. It happened. Nothing happened, but
holding steady.
Holding steady.
Okay.
They're approaching it, right? I mean, inflation has been a lot stickier there in some ways. Monetary Policy Committee voted 8-1 to keep rates steady there at 5%. So we wanted to get a little bit more reaction on this with Hugh Worthington, Bloomberg Intelligence European rate strategist. Okay, what was your take from the BOE?
Yeah, it was very much in line with expectations. That going into the meeting, markets had sort of about a 15% chance of a cut today, which is sort of almost option value, really, isn't it? So, but I think it's got to be taken into context. And at the last meeting back in August, the Bank of England did surprise us a little bit in cutting rates back then. Back then it was priced as 50-50 risk, and they got the ball rolling then. So basically they following on from the ECB in June when they cut, and the Bank of England got the ball rolling, and they basically said today, I think, that effectively they are now looking at probably a series of cuts. So the next cut seems likely to follow the one in August in November, I would say, there's probably means that we're going to be looking at like a series of cuts. The 50 basis point cut from the Fed yesterday, I do wonder whether that might eventually at some point, if we get more of that sort of thing, that might put a little bit more pressure on the Bank of England, possibly to have to sort of front load things too at some point. And obviously the stronger pound today, they'll be keeping an eye on that too, I'd have thought.
So, Hugh, just give us a snapshot here of the economic conditions on the ground in the UK, including inflation. What is the Bank of England looking at?
Yeah, so inflation in August came in at 2.2%, which is just above their target. But they are expecting a little bit of a reacceleration in inflation, mainly due to base effects around energy. Now, back in August, they're actually expecting inflation in around November time to sort of rise back up again to 2.7 to 2.8% area. But actually in this week's meeting, they've actually told us that they now think that's going to be sort of more like 2.5%. And then inflation starts to sort of tail off again into next year. And actually on their official forecasts that we saw a few weeks ago, they actually think that inflation starts to undershoot their expectations in 2026 at around 1.5%. So they're sort of the view that inflation is playing ball. It is coming down. It is getting into target. But obviously, in the short term, there is going to be this little sort of edging up again before it starts to come down again.
It does feel though that. And I was up in Canada talking to the deputy governor of the Bank of Canada over the week, and that inflation being a little bit sticky or wavy, I did kind of a wave to describe it, whether you're in the UK or whether you're in Canada or different parts of Europe, is different than what we see in the US, and that maybe the central bank will look through any sort of rises on that sense. Is that fair?
Yeah, I think so. I mean, I think the growth outlook in Europe is nothing like what you're facing in America. We're not talking about complete stagnation, but I think you're talking about sort of real GDP in the UK this year is going to be running something like 1.3, 1.4%. Next year it's going to be sort of similar sorts of numbers as well, and it's the same in Europe as well. So there's much less of a demand pull aspect of things, where compared to America, where I think at the moment at least growth looks much stronger. Obviously maybe the Fed knows something that we don't have on that front, but yeah. So it's the outlook is not as robust, I'd say, fundamentally in Europe as compared to America.
All right, Hugh, thanks so much for joining us. Really appreciate getting your perspective. Hugh Worthington, he's a European rate strategist for Bloomberg Intelligence, joining us via Zoom from the London headquarters, Queen Victoria Street in the city of London. So the Bank of England kind of staying put, at least for the time being, but the Federal Reserve lowered its benchmark interest rate by 0.5 percentage point Wednesday in an aggressive start to a policy shift aimed at bolstering the U.S. labor market. At the press conference, Fed Chairman Jerome Powell says that no one should look at the 50 basis point cut and assume it's the new pace. Let's take a listen.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. We're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate. You can take this as a sign of our commitment not to get behind.
All right, that was Fed Chairman Jay Powell yesterday at his press conference prepared remarks. Michael McKee was there. Michael McKee's now here in our Bloomberg Interactive Broker studio. He's international economics and policy correspondent for Bloomberg News. I don't know, Mike, looking at the markets today, it seems like everybody's pretty happy with what the Fed did yesterday. Do you think they feel like they've kind of gotten it done, gotten it right?
Everybody except people who are investing in the long end of the curve.
That's right. We have actually a steepening curve here, Michael.
A steepening curve. And I think basically the aggressiveness of the Fed has some people worried about, this could be a sign of inflation later if we have the economy react very quickly and strongly. But it's funny how Powell said, don't take this as the new pace, and yet if you look at futures trading for the next meeting on November 7th, they're pricing in not quite 1.5 cuts. So they're still hedging their bets about the possibility of another 50. That'll all, I don't want to say be data dependent, but it'll all be data dependent.
But when we say data, is that literally the jobs data, like initial jobless claims and,
it's probably going to be more inflation at this point, because we did have some not worrying, but we saw inflation and core inflation for CPI, PPI go a little bit, and if that continues, we'll see next Friday with PCE. If we see that again, then the Fed might be a little bit concerned, and that would take a 50 certainly out of the equation, might lead them to pause on a 25. The jobs numbers could also influence this as well, but right now, things look pretty good in the labor market.
So we did have a dissent yesterday, the first time, I believe, in 19 years somebody was
2005,
yeah. So, does that mean anything to you? Should it mean anything to the market?
It's a historical curiosity, but what it means is that the Fed is not completely united on the pace and timing of what they're going to be doing. And you can see that in the dot plot. Dots go on your Bloomberg screen. And basically what you see is a wide dispersion in the 2025 numbers, and even more in 2026. In other words, there's not a real consensus about how many times they're going to be cutting rates next year. Right now, they're timing it so they get about 1 a quarter. That could speed up, or that could slow down, depending on how things go. And there's so much out there we don't know. The political landscape next year, the economic landscape. It's just impossible for the Fed to. You can't hold them to this. Put it that way.
which I feel like he made very clear. I mean, and did his best, even though everyone tried to catch him on that. So, what about neutral? Now it feels like all the notes I'm getting from economists are talking about what that neutral rate is. He said it could be significantly higher, but didn't say kind of where. How do they know what to cut to if they don't know where they're going?
That's a very good question.
I got a good question?
You got a very good question.
I don't know if Mike's ever said that to me before, by the way. He's one of my best friends.
We don't have an answer. They're basically just going to feel their way along and see at what point things, if they push things too far, or if they see the economy sort of responding well. The idea is that maybe potential growth moved up, because we're seeing growth a lot faster than we had been seeing, as the people spent money they got from the pandemic and invested it, and maybe that's paying off. So if that's the case, then the neutral rate is going to be higher. They pushed it up 0.1% this time in their projections to 2.9%. The Fed looks at it as the neutral rate is something like maybe 1%, so then you add inflation into that, and you get 2.9.
So we're data dependent, and I hate to ask, what's next? Where do we go from here if you're the Fed? You're just going to sit back and really
well, you watch the CPI and the other inflation indicators, and you pay a lot of attention on October 4th when we get the next jobs report. And then you just sort of keep your head down and see what happens on the political scene.
Oh yeah, and
it's really the rest of the meetings we have this year probably won't be as influenced by who wins the presidential election as what's already on the calendar. We don't know whether they're going to come up with a way to keep the government open. So the government might be closed by the time the next Fed meeting is. And also you go into next year knowing you have the tax issue, the expiration of the tax cuts, and you have debt ceiling issue. So you've already got things that could really upset the apple cart. Then throw on top of that whoever's president and whatever they're going to propose.
Janet Yellen, Treasury Secretary, is saying that the Fed's move is a very positive sign for the U.S. economy. Does this actually reaccelerate demand and growth possibility? We have like 30 seconds.
Probably not a whole lot immediately. Even 50 basis points isn't going to move things much. We already saw mortgage rates and auto rates come down into the Fed meeting as people bet on that happening. So it's probably not going to have a major effect, but they'll start to accumulate, and next year you'll start to feel it.
All right, good stuff. As always, Michael McKee, thank you so much for joining us. Michael McKee, international economics and policy correspondent for Bloomberg News. He was in D.C. yesterday, back in New York today.
Hey, I was in Canada yesterday.
You were in Canada.
Yeah.
That's right.
Yeah, I get. I mean, DC is like whatever, dude.
I know.
Yeah,
Now, did you use your global
I
entry?
go through customs. Yes.
Okay.
Oh
Worked like
my
a charm?
God,
Isn't that
that
worth it?
thing is amazing.
Amazing.
I made my husband and my daughter get it after we flew back from somewhere earlier this year because I'm like, I'm not waiting in this line with you guys.
No,
like
exactly.
you're on your own.
Exactly. Let the little one take the subway home. You know, I mean, that's what
Totally.
we're talking about. Just fantastic. All right, markets moving this morning on the back of that Fed data point. S&P 500 up 1.6%. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with his Bloomberg Business Flash. Lower rates, good for risk assets, especially for tech, information technology, best performing industry group in the S&P 500. Some of the individual stocks today, Walmart customers soon going to have the option to pay directly from the bank accounts with instant transfers for online purchases. So this actually cuts out the card networks. Apple being warned by the European Union to open up its iPhone and iPad operating systems. Those are highly guarded systems to rival technologies or eventually risk significant fines. And data this morning showing a slide in jobless claims to the lowest since May. So the labor market does remain healthy despite a slowdown in hiring. Some of the other data, used homes falling in August, the sales to a 10-month low. Persistent affordability challenges. Still expensive out there. S&P 500 right now, 89 points higher. That is up 1.6%. That's a record if we stay on this pace. 5707 on the index right now. The Dow Jones Industrial Average, 396 points higher. That's up 1%. That would be another record for the Dow if we close at these levels, 41,906. And the NASDAQ 100 up 487 points. That is a rise of 2.5%. And 13 basis point difference right now between tens and twos. That's a normal looking curve at this point. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul, Alex.
Did you say used homes? I've never heard anyone
I don't want
say
to.
used homes.
Who says existing homes?
A
out
used
there?
home sounds like I just threw a frat party and like left the keg there and then sold it to you.
That's the voice of experience.
No, only one keg stand in my life. All right, JT, thanks very much. I'm Alex here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economic, and finance through our lens of our Bloomberg Intelligence folks. We're broadcasting to you live from our Interactive Broker Studio right here in Midtown Manhattan. And I have a special guest for you up next here. So LyondellBasell, if you don't know the company, ticker is LYB. It's basically a chemicals company. It's a $30 billion chemicals company. Think things like plastic. It is also doing a lot of shift into sustainability, retrofitting certain plants to make greener stuff. And this stuff is important because it's things we use every single day in the most mundane things, and it's difficult to really decarbonize those sectors. Joining us now is Tracy Campbell, Executive VP of Sustainability and Corporate Affairs, but she's held many positions within the company. Tracy, great to see you.
Thank you. It's a pleasure to be here, and who doesn't want to be in Midtown Manhattan on a day like today? So
I know.
Thank you.
That means it's nice out, right?
It is
okay,
gorgeous
great.
outside.
We'll take your word
trust
for it.
me. Yeah.
So let's just start with the macro for a second, because for those viewers who don't know, LyondellBasell makes all the stuff we need: plastics, ethylene, all the things.
Right.
How's it going? Like, what's demand like right now?
You know, demand has been very steady, certainly in the Americas, and I think demand got a bit of a boost yesterday. The economy did as well, so we're excited about that. And while, yes, some of the global markets are substantially weak, China, for example, is an important market, but we're not as exposed there as others. And of course, Europe's a bit slow to recover as well. But no, we're really excited about the demand that we're seeing here in the Americas. And I've been in the industry for more than 35 years. I've lived through this cycle of low demand and strong demand, and we don't subscribe to this doom and gloom that you hear out there. So we're excited about the recovery that we're going to see, because as you said, Alex, we make the materials that people count on every single day, and that's fundamentally not changing.
How does a company like yours and any global petrochemical company, plastics company, how do they balance the business requirements, grow the business, invest, deliver profits for shareholders, and then make this transition to maybe a cleaner business? How do you guys balance that in general?
We see it as an and. When you think about the value play that we have for more sustainable products, whether they're more circular, perhaps they're low emission products, we believe that that's a value proposition for the company as itself. And we have a play there because we can bring these products to market at scale. We're not doing it for the greater good of society. While that's an added benefit, we're doing it because we believe it's accretive to earnings in the long run. So there are consumers and brand owners out there that are looking for those materials.
So in what sense does this happen? Is it like we're going to use greener feedstock to make stuff? Is it we're going to use alternative energy, renewable energy to run our plant? Or is it we're going to capture any sort of emissions and then deal with it? Like, what's the strategy?
There are multiple strategies there, and I think you hit on quite a few of them. If you think about our strategy as a company, we still believe that our core petrochemical business is here to stay. However, we can change the way we operate, the feedstocks we use, the type of, like you said, renewable energy and things like that to lower the emissions that are being generated as we make these materials. You know, another core piece of our strategy is to really, again, leveraging our core business to fund a much less capital-intensive ecosystem for circular products, for things, waste materials being brought back into our system and using those as the feedstocks, essentially, for the products of the future. So really, there is renewable energy. There is low carbon emissions. There is technology out there for carbon capture and utilization. All of these are part of the transition, including hydrogen, for example, to bring either fossil-based materials or renewable and recyclable materials to the market. That we're looking at all of those.
Oh, I know. I mean, your company is truly a global company. Roughly half the revenue in the U.S., half your revenue outside the U.S.
That's roughly right.
How is it? How are the requirements or the environments for maybe migrating your company to a more eco-friendly business model? Is it different in the U.S. than it is outside the U.S.?
I think the pace of change is different in different parts of the world, but we see that change happening on a global scale. For example, in Europe earlier today, in fact, in Germany, you'll see our press release soon, we are laying the foundation stone of our first scalable advanced recycling unit, and we see the Germans sort of and the Europeans advancing quickly, right, with respect to embracing circular and low carbon. But we are seeing the same trends here in the United States and even with our joint ventures and our activity in Asia. So it's just happening at a different time scale, but the momentum and the energy and the excitement around those products is really not different. The policies might be a little bit different depending on what country we're operating in, but our direction is still the same. So we're very excited about that announcement today in Germany.
So talk to me about cost for a second. So the working theory is that when you make stuff green, it costs more. So A, is that even true? And if it is, how do you offset those costs? I mean, yeah, and how do you offset it? Like, do you wind up having, do the end user have to pay more? Or are there different ways it's offset, even if it's from policy like tax credits?
Mm-hmm. You know, when technology is new and when you're transitioning technology, yes, there are investments that need to be made to accelerate that transition. So, you know, I don't think in the long run the materials will cost more, but the transition, of course, is what's where the investment is tricky, right? And we need to look at that. But if you look at consumer demand for these materials, if you look at the government's programs that are out there to accelerate the transition, the unit that I spoke about that we're laying the foundation stone in Germany just this morning was a recipient of a European Innovation Fund, you know, millions of dollars to help us with transition. But we really see the consumers stepping up, the brand owners stepping up, and I think over time the technology to make this transition, tax credits, for example, for hydrogen production, for hydrogen consumption are important as well. So I really see a lot of activity in that space to help us transition.
Jason from Omaha, Nebraska writes in, how have ocean freight costs affected the U.S. ability to export our cheaper plastics to the rest of the world?
Ocean, you know, I'm not an expert on ocean freights anymore.
Okay.
I used to be at one point in my career.
You can still play one on radio.
Yeah, I can still, pretend. But, you know, what we think about as our company, we really focus on differentiating our assets in terms of feedstock advantages, technology advantages, scale advantages. So do we have assets in regions that depend on ocean freight? Mm-hmm. Absolutely. We have JVs in the Middle East. We're growing there. We have owned assets in the United States. And yes, we do export these materials and we stay on top. And we actually have a supply chain organization that is constantly looking at the optimization of freight to make sure we can deliver those materials to market very competitively.
In terms of all of it, the transition, dealing with current slowdown in Europe and Asia, et cetera, and this comes from Orion Hornan, so see, I'm going to ask your question. Do you think that animal spirits will awaken and we get more M&A in the chemical space with those low rates? And then I would add on, are you kind of forced to make acquisitions or even bolt-ons as you're also making this energy transition?
You know, growth is important to us, and I talked about growing and upgrading our core and even growing this circular and low carbon economy that we're looking at. So I think M&A is always part of our optionality, right? You've seen us grow our footprint in the Middle East. I lived in Asia recently where we grew some footprints, we grew some joint ventures over there. So I think M&A is always going to be in the cards for us, and we do see ourselves as a consolidator and a very efficient, scalable provider of these circular and low carbon solutions. So there's a lot of activity that we're doing there to consolidate feedstock acquisition, to build these integrated hubs in order to have a very scalable and optimized delivery system for these materials of the future. So M&A is always an option for companies of our size, for sure.
Again, as a global company, I'm guessing you guys have a vested interest in all this talk coming out of Washington to various degrees, various parties about tariffs and things like that. Does that impact your business? Has it impacted your business over the last 4 or 5 years? And
Tariffs to me are, I'm a believer in a free market economy.
Right.
And I think tariffs in the long run tend to hurt that. So, we really are positioning our company to be resilient no matter the outcome of any election in the world. So, we're making sure that we've got the right products, the right assets. We have that differentiation to really be successful, regardless of whether a particular person wants to have tariffs or not. So
that was a very that was an SVP answer.
I try to be an enterprise thinker.
It's fair. It's fair. When we talk about the cost situation, and this also plays into Paul's tariff question, do you secure customers for your products and that then help you build the product, or after it's done, do you have to go out and sell them? And what do both of those processes look like?
We work with brand owners and with customers to build the future materials and to help design those applications of the future.
So they have to commit to stuff. They have to be like, we will give you this much money for this much product.
We work with them right from the early stage of concepts through design, through perhaps a long-term contract, for example. But yeah, being a solutions provider requires us to really develop those materials together.
Is it hard to come up with those numbers right now with your customers in terms of pricing?
I don't think so. I think it's always been, we've always worked with our customers and with downstream, so the entire value chain to really design the materials that, consumers like ourselves are looking for. So yes, as we work through that process, we're looking at our cost to deliver the material, the intermediate, the converter cost, the consumer cost, but I don't think the uncertainty is any more, is any higher than it's ever been, frankly. I think it's just something that we're always making sure that we design for all options and we have the flexibility to pivot if we need to.
All right, Tracy, so great. I've been trying to get Tracy on for since what, February, March of this year? Yeah.
It's great to be here.
Thank you so much. Really appreciate it. I know you're here for Climate Week, so I'm looking forward to what will come out next week as well.
Right.
Tracy Campbell joining us there. Your title's long. What is it's SVP of...
No.
I'm trying to find it.
I've got Executive VP
of
Sustainability and Corporate Affairs.
Oh, click on that email, Alex. Come on. All right. Tracy, appreciate that. Joining us from Lionel Vassell on all things energy transition when it comes to petrochemicals. All right, coming up, we're going to have more on this market. Emily Rowland, Co-Chief Investment Strategist for John Hancock Investment Management, will be joining us for her outlook on the market as you see the S&P kissing that record high today. Happy Thursday. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This Bloomberg Business Flash. Stocks hitting all-time highs today. S&P 500 that's poised for its 39th record for this year. Russell 2000 small caps extending its advance into a 7th straight session. Meantime, Sarah House at Wells Fargo saying, you know what, the Fed has room to make more jumbo rate cuts after yesterday's 50 basis point cut.
If the Fed really is getting more worried about the jobs market, I think there is potential room for another 50 basis point cut, especially when you're still looking at the Fed funds rate still above even the highest estimate of neutral among the committee. So still leaves room to cut big.
Right now, the S&P 500 up 1.75%, 98 points higher, 57.16. The Dow Jones Industrial Average also on track for another record close, 500 points higher right now. That's up 1.2%. We're at 42,000 even. And the Nasdaq 100 up 524 points. That is up 2.7%. As far as yields, the 2-year is down 2 basis points. That's at 358. The 10-year up 2 basis points. And that is at 373. Housing markets seeing better days, though there is reason to anticipate some improvement. National Association of Realtors reports sales of previously owned homes dropping last month to the lowest since October 2023. Affordability is still the issue. And Amelia, how do I run my business? Amazon launching an artificially intelligent assistant designed to help online merchants manage their businesses. It's codenamed Project Amelia. The new tool is going to answer a range of questions like how to prepare for the holiday season to suggesting the wording of product listings. If you have to use an artificial intelligence assistant for that, probably in the wrong business, I would suggest. But what
got some bigger problems.
That implies I was listening to what you just said. He's looking at me like, oh, you're listening to me, right?
I'm sorry to disturb you over there. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and this is your Bloomberg Business Flash. Paul and Alex, are you there?
Yeah, I'm here barely. I mean, let's be honest. All right, John Tucker, Alex Steele, Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries worldwide. Markets at a record. There's some serious volume coming into play. I was talking to one market technician who was like, we got options expiration tomorrow. You got to reshuffle your delta, which I guess is a fancy option word. So that's why you're seeing a lot of the flows here. Emily Rowland is co-chief investment strategist for John Hancock Investment Management, and she joins us now. Emily, do I just blame technicals and options expiration, or is this some serious real FOMO here?
Yeah, no, I think that's probably some noise that does occur periodically. You know, look, markets are celebrating today. We're near new all-time highs, or kissing them, as you said earlier. And I think there's a lot of relief around this dovish pivot that the Fed has taken here. There was a bit of confusion in the markets yesterday after Powell came out and told us not to get too excited that more 50 basis point cuts aren't coming. But I think overall it was a dovish Fed meeting, and it looks like markets can continue setting themselves on soft landing island.
Soft landing island.
Very nice.
Netflix season 1.
Exactly. Hey, Emily,
Right?
we've actually got a yield curve that's steepening here. We got the 2-year at 3.58%, the 10-year at 3.72%. What does that tell you?
Yeah, I mean, bond yields came a long way prior to this dovish Fed meeting yesterday. So I think you're seeing a little bit of repricing there across the curve. You know, I think that we could see some chop in rates from here as we kind of navigate through this environment where there's kind of some better than expected economic data. You know, maybe we're continuing to see some broad deceleration. But again, this deceleration is happening slowly enough that it's sort of providing this perfect backdrop for the Fed to, you know, to continue to implement rate cuts amidst a decelerating economic environment. It's going to happen in choppy fashion. But for now, I think you're kind of going to see rates hold steady, as yesterday was the big event. We've gotten through it, and we'll see what happens from here.
So do you chase here, or is there something on your shopping list, or is it just a rotation at this point?
Yeah, I mean, we would look at any backup in bond yields as a nice opportunity to lean in. Income there is still elevated. Of course, yields have come down a lot over the course of the summer, but we still don't think that bonds have fully sniffed out this disinflationary, lower growth environment. So we like higher quality bonds, areas like mortgage-backed securities, investment-grade corporate bonds, sprinkle in a little bit of treasuries there. So we think there's a buying opportunity there. You know, stocks are fully reflective of this soft landing backdrop. We continue to embrace higher quality stocks. And we're looking for areas that provide quality at a reasonable price as well. So we would be leaning into things like healthcare stocks. We're legging into more defensive areas of the market like utilities and infrastructure equities. And we continue to see U.S. mid-cap stocks as a big beneficiary of onshoring activity and the fiscal spending that's still happening against this decent economic backdrop.
Emily, when you get big moves in the market like we're seeing today, that kind of just raises the valuation flag for a lot of investors. How are you kind of thinking about valuation in the equity markets?
Yeah, I mean, it's not great. I'll tell you, you know, certainly with markets, you know, bumping up on 21, 22 times forward earnings, I think they're well priced for the soft landing scenario that we've been talking about. You know, and you look at areas like technology stocks, which are trading at 30 times forward earnings, which is about as high as we've gotten over the last cycle. It's not the 50 times forward earnings that we saw in the late 1990s. So I think the froth is a bit of a concern, but I would tell you that valuations just simply aren't a catalyst for a market rotation. They haven't been historically. I think you'd need to really see some kind of shift in the economic regime. You'd have to see a big shift in earnings trends to really see that market leadership change. And, you know, you can blame a lot of things on the multiple expansion that we've seen in technology, but you can't blame the denominator. The earnings have been there for these companies, which makes us continue to be constructive there.
Which also then raises the question, where do you go in terms of large, mid, small? So I've been reading a lot about, particularly from Bank of America, how maybe this is the time for mid caps. And mid caps hit a record high yesterday. They outperformed today. They outperformed yesterday. Like, is that the sweet spot for that environment that you're talking about?
Yeah, mid caps are the sweet spot for us. You know, when you go down into small caps, you're looking at companies that are unprofitable. They have higher interest burdens. You know, the Russell 2000 is comprised, about 40% of that index is comprised of companies that don't make money. They could do really well in an early cycle environment, but we just don't think that we're there yet. And you see these little rallies in small cap equities based on the idea that rates are coming down. But remember, rates are coming down because there's a challenge with growth. And we think that that does not benefit the most cyclical areas, namely small caps. Moving up into mid cap equities, you get a big overweight to the industrial sector. So think about the relative sector composition there. And we think mid-cap industrials are massive beneficiaries of the spending that's happening in the U.S. There's a manufacturing renaissance happening right now in the U.S. Midwest due to onshoring and due to things like the CHIPS Act and the Infrastructure and Jobs Act. So we want to look to mid-caps as a way to capture that. They're also trading at the deepest discount to their large cap counterparts since the late 1990s. So you're not overpaying for this theme.
Emily, how do you feel about the earnings backdrop here for the market?
Well, I love it going into the third quarter because the bar is low. It's actually, analysts are penciling in 4.3% earnings growth as we look forward to the next quarter's earnings season. So we love a low bar there. I think we should enjoy it while we can. Because Q4 earnings growth is penciled in to be about 15%, and then analysts are looking at 15% into next year. So not only is the market trading at an elevated valuation, but that's also against expectations that we're going to see about 15% earnings growth next year. That's probably a bit optimistic. So we may, you know, see a challenge to that. Right now, multiple expansions helping as we continue to embrace the Fed pivot here and the soft landing, but ultimately the earnings need to come through as stock prices over time are going to follow profits and follow earnings. So we think that's going to be critical to watch as we look forward.
Emily, great stuff. Really good to see you. Emily Rowland, Co-Chief Investment Strategist for John Hancock Investment Management, joining us there. So this was a fun piece in the Wall Street Journal, ready? So apparently, coming soon on Amazon Prime TV, you're going to have basically Shark Tank for stuff. So sellers are going to duke it out on TV to get their wares prime placement at the world's largest online retailer.
Really?
So you fight it out, and then you get placed on Amazon for people to buy your stuff.
Wow, that could be big.
Isn't that kind of cool? I thought that was pretty cool. Good thing that Geetha Ranganathan will be joining us. She is Bloomberg Intelligence U.S. media analyst. She'll be joining us right after the break. This is Bloomberg Intelligence. Happy Thursday.
Headlines and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, happy Friday Eve, happy post-Fed day. I'm Alex Steele alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We're broadcasting to you live from Interactive Broker Studio. We're right here in Midtown Manhattan. It's a good moment to check in on media stuff and media deals. And I read that really interesting article in the Wall Street Journal about how there's going to be a show on Amazon where people get to basically compete to get a slot in their big Amazon.com store. So they're describing it as like Shark Tank meets Home Shopping Network, which, I don't know, for me,
you
this
would
is
actually
like
watch this.
100%. Would you not? Okay, you're not going to watch it, Paul? No, that's not his thing. Geetha, help me out. Geetha Ranganathan, Bloomberg Intelligence U.S. media analyst. This sounds brilliant to me. Did you see this article?
I did not, but it definitely sounds intriguing.
So it's a new competition show next month. Entrepreneurs are going to pitch their products to a studio audience as well as to judges, including Amazon executives and some celebrities like Goop founder Gwyneth Paltrow and designer Christian Siriano. And then finalists will have their inventions sold in a new Amazon Buy It Now online store.
That's synergy.
That's what I'm saying. Yes, whether or not you watch it, that is some synergy. So she's not going to watch it. Am I the only one that can watch it?
I think so.
All right, fine. All right, you talk now, Paul.
All right, Geetha, thanks so much for joining us here. What I want to talk to you about is just kind of where are we these days, Geetha, on cable networks staying on cable systems like the old days. I know Warner Brothers Discovery, they have a new deal with Charter. Talk to us about that and why it's important.
This was a really big deal for Warner Brothers Discovery. And the reason it's such a big deal is, of course, one thing is 90% of Warner Brothers Discovery's profits actually come from its television networks. But the reason it was so critical, and especially from a timing perspective, was because Warner Brothers has just lost its rights to NBA programming. And remember, NBA is one of the main draws for TNT, which is their most expensive channel right now in their network lineup. And so there's been a lot of fear, amongst investors that Warner Brothers TV revenue, especially its affiliate fee revenues, is going to be a tremendous risk. And so this deal actually with Charter, it was actually coming up for renewal only next year, but I guess David Zaslav wanted to go ahead and assuage investor fears, and so he signed this deal a whole year in advance, maintaining the same affiliate fee revenue trajectory. So it's definitely provides some temporary relief just from an outlook perspective for Warner Brothers.
All right, fine. See, but they're struggling because there's cool shows like this, like Shark Tank and Home Shopping Network on Amazon now. Whatever, fine. All right. So, what other questions are still bubbling up in the media community? There was a great piece on Bob Iger's succession a couple weeks ago, talking about that. What else are you focusing on?
So carriage continues to be a big, a big bone of contention across the whole TV space, Alex. I mean, yes, we had this Warner Brothers Discovery Charter deal, which was somewhat of a low drama deal, but there was one that was high drama, and that was actually Disney with DirecTV. Those two companies were fighting it out. There was a blackout of all Disney programming on DirecTV systems for almost 2 weeks until finally both of them caved. And Disney obviously wanted to have carriage-free increases, which I think it got. What DirecTV was really looking for was more flexibility in, programming and packaging, and they got that. So we're seeing kind of all these deals become really contentious as kind of the whole video landscape keeps shifting. So carriage continues to be a really big thing. And then the other thing is, of course, we have the M&A chatter coming up every now and then. The most recent one, of course, was DirecTV with Dish. That will obviously have huge implications for the entire TV landscape.
So let's switch gears a little bit to a business that I think is actually investors still like, and that's the theme park business. When we think theme parks, we think the Walt Disney Company, and I'll be down at Walt Disney World in a few weeks doing some due diligence. But Comcast also has a big theme park business. Talk to us about their theme park business and the investments they're making and how important it is to that company.
Oh, absolutely. So with Comcast, I mean, when we think of Comcast, we always think of the cable business, and rightly so. Cable actually makes up 80% of their EBITDA. But the one area that has kind of been ignored for Comcast, I think, over the past few years has been their NBC division. And NBC, through Universal, of course, not only owns TV networks, studios, but also the theme parks. And the big thing for Comcast and its theme parks is they're actually opening a whole new theme park next year, which is Epic Universe in Orlando. It actually doubles their entire Orlando footprint. So they go from about 800 acres right now in Orlando to almost 1,600 acres with this park. And it's going to obviously do, so much for their attendance. So right now, Universal attracts about 30 million subscribers domestically to their parks. Of course, the big behemoth is Disney with about 80 to 100 million almost domestically. But with this, we think Comcast actually kind of gets closer to Disney, right? They can get to about 40, 45 million visitors to their domestic parks on an annual basis. So it's going to do a whole lot for their attendance. And really, Paul, as we kind of see the business going out, we think, theme parks almost, it used to be a few years ago, theme parks was about 25% of NBC's profit. In a few years, we think theme parks can actually be 50% of NBC's profit.
That's fascinating.
Well, it is and it's not. It's good because the theme park business is growing, but it also reflects the fact that their cable network business is declining dramatically, and that's the cash flow historically that investors have liked.
I mean, I guess I wonder, though, too, is that also more recession-proof or not? Like, what goes first, ad spending for a linear TV or people not taking their kids to Disneyland? Is there an Avengers theme park? Do we know?
I don't know.
Why am I asking Paul? I don't know. All right, anyway. Thanks, Geetha. We appreciate you. Geetha Ranganathan, Bloomberg Intelligence U.S. media analyst. All right, we got a great Second hour of Bloomberg Intelligence coming up for you. More on the market, sitting right at record highs with Dave Fakudla, founder and CEO and chief investment strategist over at Mainstay Capital. We're also going to get the latest on what's happening between Hezbollah as well as Israel with Ethan Bronner. We're going to head down to Tel Aviv and chat in with him. He's the bureau chief over there. And also Mickey Naftali, CEO and founder of Naftali Group. Let's talk about real estate as we finally get that 50 basis point cut. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, everybody. Happy Friday Eve. Happy post-Fed day. I'm Alex Steele alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We are broadcasting to you live from our Interactive Broker Studio right here in Midtown Manhattan. We have a great hour lined up for you. We're going to talk about markets sitting right at record highs. Why? And kind of what do you do about it with Dave Fakudla, founder, CEO, and chief investment strategist at Mainstay Capital Management. Also, we're going to talk real estate. We get that 50 basis point cut. What does that mean for the real estate market, particularly office commercial real estate? Mickey Naftali will be joining us, CEO and founder of Naftali Group, and also Barry Ritholtz, the man himself, his takeaway from yesterday and what he's looking forward to over the next couple weeks. Founder of Ritholtz Wealth Management and host of Masters in Business will be joining us. So lots to look forward to, and let's kick it all off with a business flash with John Tucker. John.
All right, it took a day, but investors finally waking up to the fact that lower rates are good for risk assets. Dow Jones Industrial Average on track to top its record that was set on Monday. The S&P 500 above its all-time closing high that was set back in July. Most active in today's trading, shares of NVIDIA, they were up close to 5%, lowering interest rates, delivering a boost to big tech especially. Well, after the 0.5% rate cut from the Fed yesterday, we heard today from capital markets at RBC, Amy Wu Silverman. She is cautious on risk assets moving forward.
I don't believe there's much upside left. I'm willing to trade that at this point to buy myself a little protection, given that we know there's a lot of volatile events, a lot of swings in the months ahead.
Darden Restaurants, owner of Olive Garden, that is the best performing stock right now in the S&P 500. It's up over 7%. Did get some data. Weekly jobless claims remain subdued. This is on a historic basis, even as hiring tapers off. Last week's tally of 219,000 initial claims is actually the lowest since May. S&P 500, 85 points higher. That's up 1.5% at 5703. Dow Jones Industrial Average up 381 points. That's a rise of 0.9%. We're at 41,886. And the NASDAQ 100 up 479 points. And that is a rise of just about 2.5%. Now we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash, Paul and Alex.
Hi, John Tucker. Thank you so much. We appreciate that. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast, and that's where you will find us. As John Tucker was just reporting, markets are ripping here today, up 1.5% on the S&P 500. Let's see where the action is under the hood. And for that, we go to Norma Linda. She covers all the equity markets for Bloomberg News. Nora, what are you looking at?
Well, it looks like the market is loving that rate cut that we got yesterday. When we looked at the close yesterday, I felt like investors weren't really sure where to land, but today we are really seeing a rally. It's a risk-on mood, and this is really, of course, with those rate cuts, making people realize that more Fed liquidity will be put into the system, and we're seeing the S&P 500 topping the 5,700 mark, and this is buoyed by tech stocks. We're seeing information technology as the best-performing group in the S&P 500. NASDAQ 100 rallying as much as 2.9%. I'm even looking at Apple. I mean, they received a warning from the EU to open up their iOS system to rival technologies. You would think that investors would be a little bit, apprehensive about this, but they're shrugging it off. We're seeing the stock Apple up more than 3%, rallying for its best day since June.
Darden Restaurants? Remind me.
Olive Garden. We've got what?
Olive oil.
Let's steakhouse.
Olive oil.
Olive oil.
Sure,
they probably pour lots
of
it,
there.
right?
Yeah.
for our arteries.
They also made a partnership with Uber.
Uber,
right? That
yes.
was kind of a big deal.
Yes, that's the big deal that's really overshadowing their results. I mean, they were seeing soft sales, but this new pact with Uber, they are the first group to really work with them in terms of this food delivery pact. And this is interesting because apparently Darden was a bit more apprehensive about working with a lot of delivery companies. And so this is going to be a really big shift for the company. But we're seeing shares of Darden, that's ticker DRI, surging as much as 9% for the biggest intraday gain since September of 2021. And as John mentioned earlier, this is the biggest percentage gainer in the S&P 500 right now.
Well, since you're not going to bring it up, I'll do it. Cracker Barrel, CBRL, home of a country boy breakfast. Stock's off a little bit here today. We'll go out there.
I went 2 weeks ago and I thought of you all because we had this conversation about Cracker Barrel a couple months back. Alex still hadn't gone. I was hoping it would have changed, but
well, Paul told me to go. Where were we again? Was it Nashville?
We can go in Orlando. We'll go in Orlando.
Okay,
please do.
Actually,
and report
Nashville
back.
Couldn't have been any easier. It's literally across.
It was
the
across the street.
It was
to be fair, I was really sick, so there was
Yes.
even that was like a whole
Excuse
different
is
thing. It's true.
Revenue rises, but profit drops on higher costs.
Yeah, well, that
All
feels
you
like
need to
that's pretty legit when it comes to restaurants right now, right? Your top line might be okay, your margins get squeezed. Your margins are good, and your top line suffers. All right, Nora, thanks a lot. We really appreciate Norma Linda joining us there for all the market drivers of the day. All right, let's get to David Kudla now, a founder and CEO and CIO and Chief Investment Strategist, I should say, at Mainstay Capital Management. He joins us now. Hey, David, are you buying into this record rally here?
We're buying into this record rally. I know that there are many who are still concerned about a recession, that are worried that the price of stocks at these levels, we're at new highs. But look, what we've seen here now with this cut yesterday, and what we have going forward, if there's such a thing as a Goldilocks scenario, we're about as close as we can be to it. So, I've had the expression for the last 2 years, the recession that's always 6 months away. The recession is always 6 months away. GDP right now, Atlanta GDP now for the third quarter is at 2.9%. We had 3% growth in the second quarter. We're still looking for that soft landing that the Fed rarely pulls off. So more of a mid-cycle slowdown, and then we slowly reaccelerate, and we don't get that recession. And if that's the case, 12 months later, after a first rate cut, stocks are higher and significantly higher. If you get a recession after a first rate cut, stocks are lower. So that's what we're pivoting on, but we're still optimistic and constructive on stocks at this point.
So, David, I think when I listen to some folks that are still constructive on the market, they just I think they hang their hat on a couple of things, which is one, I've got a Fed that's cutting rates, and I've got a pretty decent earnings environment. That's pretty good. But one of the things that we just don't know, it's an election year, and I don't know what that means for the markets. How do you guys talk about that to your clients?
I'm glad you brought that up. We get preoccupied with politics as it relates to our investment strategy. And when I say that, I mean at average investors out there. There are investors that believe if so-and-so gets elected, it's doomsday. If so-and-so gets elected, it's nirvana. What we find out is, and this is why we'll have volatility over the next couple of months until the election, is the markets hate uncertainty. So it's about getting that uncertainty out of the way. But then it's not as much about whether it's Democrat or Republican. As far as where we invest, as tactical asset allocators, we want to look at the difference in policies. There's differences in policies in energy and a lot of areas between these two candidates, and depending on how the House and Senate go in terms of taxes and everything. So that matters as far as tactically how we invest. But the people that go to cash because they're scared, concerned, wait and see, end up typically in election years, suffering an opportunity cost. And that's exactly what's happened this year so far for people that have stepped to the sidelines.
Is there a risk, if I pivot back to the Fed for a second, so put elections on the side, is there a risk that we're going to see kind of more growth and demand resurface in a particular way because we're in that rate cutting cycle, because we got that jumbo rate hike? And is that a risk eventually for resurgence in inflation?
It is a risk. But what we've seen so far is inflation is on this glide path to the Fed's target. If anything, I think with the disinflationary forces that'll come back into effect as we get by all the effects of the pandemic, we may overshoot the 2%. But we're certainly on a glide path to 2%. And right now, where we are with the labor market, we had some good news today. There's still some concern out there about credit card debt, credit card interest rate, auto loan delinquencies, things like that. But we balance that all out, and we think the inflation problem is gone. It's now about labor, unemployment. We get to the point where that needs to be. Rates come down to, if it's the long-term neutral rate of 3% here through 2025 for the Fed funds rate, we're in a good environment for stocks still. We know they're expensive, but stocks can be, we know, overvalued or undervalued for a very, very long time.
All right, David, so what sectors are screening well for you these days? Again, we've had an S&P 500 index move about 20% year to date, but I know not everybody's participated. So how are you guys approaching maybe like sector selection?
Right. So, one area for sure that's been troubled for quite a while, especially a while back here with some of a few of the bank failures, but banks, financial services look very good. As the yield curve continues to steepen, NIM improves, net interest margin for the banks. We're finally getting that yield curve steepening. So we like the financials a lot. We still like technology a lot, the AI story. But what we're able to do now, we can broaden into value. We can broaden into cyclicals. We can broaden into small caps and diversify our portfolios from the Magnificent Seven to these other areas. Small cap companies are far more reliant on debt. And with interest rates coming down, their cost of capital coming down, maybe coming down a lot over the next year, that's good for small caps. And that's what we've been seeing recently in IWM or the Russell 2000 index.
Mid caps, sweet spot, you like them?
Mid caps as well. Mid caps, the same thing. Small and mid caps just become more attractive. And mid caps are kind of that sweet spot in between. It's been a large cap dominated stock market for quite a while. We've had a lot of head fakes with small cap and mid cap, but we think they now have a runway with rates coming down.
All right, David, thank you so much for joining us. Always appreciate getting a few minutes of your time. David Kudla, he's the founder, he's the CEO, and he's the chief investment strategist at Mainstay Capital Management. I call him the boss there, I guess, basically. So that's what's going on there. Remains constructive on the markets. Let's get back to that geopolitical news of the day, and that is in the Middle East. More Israel against Hezbollah in Lebanon. We've got more personal electronic devices exploding. Let's get the latest reporting there. Ethan Bronner, Bloomberg News Israeli bureau chief, joins us from Tel Aviv. Ethan, I'm just seeing some video up on the screen. Again, we've got some of these walkie-talkies now exploding after yesterday's pager devices. We've got some strikes on Hezbollah in Lebanon. The activity level remains very high there. Can you give us the latest?
Well, you've summarized it well, as you often do, Paul. That's right. There were 2 days of personal device blowing up, first pagers and then walkie-talkies. We're still trying to get a clear assessment of the damage it did to Hezbollah. There seemed to be 2,000 to 3,000 people in hospital. Where there seemed to be 30 people who were killed. A few of them were clearly not Hezbollah. A few of them were children. But I think a lot of the people harmed, injured, and killed were mid-level and upper-level Hezbollah people. It is thought that their ranks have been harmed. The head of Hezbollah, Nasrallah, Sheikh Nasrallah, just spoke and said that Israel had crossed all red lines had been crossed, and they were going to regret it. They were going to make sure that Israel would not be able to move its residents back to the north, which is the goal. Israel wants to be able to bring the 60,000 people who've been forced out of their homes for almost a year to be able to go back home. So that's where we stand. I mean, it's a little bit, difficult to know where we're headed. The attack on the pagers on Tuesday seems to have been a last-minute decision. They were afraid that it was being discovered, so it wasn't something part of a big plan that they had figured out in advance.
Do we know anything more about where the pagers and where the walkie-talkies are manufactured?
We don't. We have a lot of reporters working on that. We do know that there was, that it was originally, it looked like it was a Taiwanese company. The Taiwanese company said actually it was with a license from a company in Hungary. We've been to the headquarters in Hungary. It's basically a post office box and so on. We've tried to chase down the names of the executives of this company seem to be fake or weird or, and so we don't really know where it was made. Where was it actually made, we don't know. But everyone seems to understand that these are real pagers that the Israeli Mossad spy agency inserted explosives into a bunch of them that were headed for Hezbollah.
Ethan, I guess we step back from a 30,000-foot level and just look at the Mideast in its entirety. It looks like, I guess maybe it's reasonable to think that just given the last several days, this escalation in Lebanon would put any kind of peace process, I guess, on a further back burner. Is that the understanding, or are the efforts still trying to be made?
Well, I think you are right. I mean, there's every reason in the world to be pessimistic about peace breaking out here. The only peace negotiations that there have been are these an attempt to find a way to get a temporary ceasefire in Gaza that could, in theory, extend into a longer-term one, and bring home the 100 or so hostages, living and dead, that Hamas is holding, Israeli hostages. Those talks, brokered by the U.S., Qatar, and Egypt, have not been going well, and I don't think that there's much going to happen. Israel did put out a new idea relatively in the last weeks, which was, we'll take all the hostages, but you have to get out of here and never come back. And Hamas is not interested in that. And Hezbollah today again said, we're not going to stop fighting you until you make peace in Gaza. So it's not, I agree with you, it's a very dark time in the region. The only question here is whether Hezbollah has been put enough back on its back foot by the last 2 days. The idea that every electronic device that they use to communicate could be infected, booby-trapped, that they would conceivably be closer to an agreement to step back from the border. But there's really not much indication of that. And that obviously is the Israeli hope.
Ethan, we appreciate it. Thank you very much for the reporting. Ethan Broner is Bloomberg News Israel Bureau Chief, joining us there on the update on the conflict between Israel and Hezbollah. All right, coming up, we're going to talk more about the market, but also what that 50 basis point cut means for commercial real estate. Mickey Naftali is CEO and founder of Naftali Group, will be joining us on commercial real estate. This is my question. Okay, you get the 50 bips. And is it immediate? Does Paul run to his broker and get a new mortgage? If you own an office building, do you immediately run to a bank? What's the pass through of something along those lines?
We'll see. I mean, I'm waiting for a 4 handle on the mortgage.
You're in a 4 now?
I'm waiting. 5. No, I'm waiting for a 4 handle.
All right.
I don't think I'm going to get it anytime soon.
This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We're being brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor to staff ratio. Small firm attentiveness, big advisor impact. Go to commonwealth.com to learn more about our consultative support and technology. The S&P 500 now is up close to 20% year to date. It's going to be a record close day if we stay at this pace. Dow Jones Industrial Average also surpassing its record closing level that was set only on Monday. And information technology, best performing major industry group right now in the S&P 500. Lower rates, particularly good for tech. Lower rates making their future potential more valuable today. S&P 500. 95 points higher. That's up 1.7%. We're at 57.13 on the index. The Dow Jones Industrial Average up 431 points. That's a rise of 1%, 41,936. And the NASDAQ 100 right now up 540 points. This is a rise of 2.8%. Now, as for yields, the more policy reacted 2-year, that is down 2 basis points. That is at 359 right now. And the 10-year yield 3 basis points higher. That is at 373. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube as well, so check us out there on the intro web. All right, the Fed cuts rates. One of the beneficiaries, I would think, would be real estate people. People, if you want to build a building, develop a building, if you want to rent in a building, buy in a building, I mean, it's got to be good for them, right? Money's cheaper. Let's talk to somebody who actually does it for a living. Mickey Naftali, Chairman and CEO of the Naftali Group, joined by Abigail Doolittle, our markets reporter for Bloomberg News. We got them all here in our Bloomberg Interactive Broker studio. Let's talk luxury condos. I'm asking for a friend here. Mickey, talk to us about the luxury condo business. I know that's an area of the market that you know very well. You're very active. Just give us a sense of how the market is in New York City these days.
Right. So the market is actually good. We opened last week 3 sales offices at the same day in the same week, which is a record for us. And all 3.
So does that mean you have 3 new projects starting?
3 new projects. Okay. They're already under construction, but we launched sales. Upper West Side, Upper East Side, and Williamsburg on the waterfront. All 3 are doing very well. There is not much inventory in New York City, and buyers are looking for the right product.
So the Fed cut rates yesterday, of course, by 50 basis points. That certainly helps you, I imagine, with some of your carrying costs. But given the fact that you are catering to a higher net worth individual, how many cash deals do you see, or does this really help, your buyers as well?
Right. So it's very interesting. The more expensive apartments, we see cash type of deals. But when we do have, for example, in Williamsburg, we have a lot of the inventory trading between 2 to 5 million. Those are buyers that usually take mortgage, and the rate cut is obviously helping them a lot. And I suspect that we'll see much more activity in the market in the next 12 to 18 months.
What is the competition like? To get the apartments? Like, is there the kind of competition that we would have seen, say, 5 years ago for these kind of properties?
Yeah, so there is not much inventory, and definitely there is not much of quality inventory. The reason is that it was and it's still very difficult to get construction loans. So, for example, developers are just sitting on the sideline. They can't get construction loans. There are not too many projects under construction in New York. That's number one. Number two, construction cost, insurance costs are just really almost double than 5 years ago. So it's very difficult to get to a point that a project makes financial sense, which means that there is very low inventory.
So you're saying that there's very low inventory, and yet I've certainly been a part of the speculation, other people have been part of the speculation that some of these massive buildings out here on Billionaires Row, or even some up on the Upper East Side, one of which I know for a fact a few years ago, a big bulk of it was empty, even though you never would have guessed that from the website. So has all that inventory that would seem to be floating out there in these fancy buildings, has that been eaten up?
No. So
But you're doing well.
No. Yes, but It's all about quality. First of all, whatever someone decide to call this 57 billionaire row, this is a different market, really mainly relying on foreigners. How many New Yorkers really want to live on 57th Street? Think about schools, think about a kindergarten, whatever, right? You need the infrastructure. It doesn't feel as a residential neighborhood. Beautiful views, big buildings, right? So those are catered to foreigners. So we had the Russians, they're not buying anymore. We had the Chinese, they're not buying anymore. And so on and so forth. And every time there is a wave of foreigners that are coming to New York because New York is still the capital. I see it as the capital of the world, right? But this is a very different market. It's also about quality. Yes, there are a couple of buildings that are not selling well, but when you dive into the detail and you walk those buildings and you look at those apartments, they're not good. They're not well designed. They're not well, aesthetically, they're not good. You know, whatever, maybe they are in a busy area. So it's all about the buyers are very sophisticated. Buyers know what they want. And when they see a product that is well designed, well located, and reasonable price to the market, to whatever the market, they're buying. There's not much inventory in this segment of the market.
That's really interesting to hear about a divergence within the high end there. I would not have necessarily anticipated that.
All right, so you call me up, and you want a construction loan.
Right.
Why am I making a loan to you, and maybe I'm not making them to other people?
You're right, and I have an answer on the two sides, because part of our business is debt business. Okay. We are lending to other developers, so we're running also a debt fund. And it's all about reputation, and it's all about, can this developer can really get the project done? And the commercial lenders are looking at you, okay, if you ask for a loan, and they look at your reputation, what you have done. I mean, are you capable to do it? Do you have enough equity? And if your underwriting make financial sense. And if you are dreaming dreams and the project that you have in mind is not going to make financial sense, you're not going to get financing. Definitely not from the commercial lenders. You might be able to get financing at 10 over SOFR, right? Okay, you're not going to make it, right? So you really want to be in the mid 3s to low 4s over SOFR, and that's the only way you're going to make it.
Are there any deals you think to taking office buildings and converting them? I feel like this is a pretty sensitive topic. Like some are like, yeah, I can totally make money off of that, and others are like, no way.
Right. So there's a lot of hype about that, and from 2000 to 2007, I converted a lot of buildings in New York from office to residential. So I have a lot of experience doing so. Most of the office buildings, their floor plate, each and every floor is just too big, too deep. Residential, you have, for each and every bedroom, you have to have light and air. You have to have a window, you have to have legal light and air. There's a certain distance that it needs to be from the neighbor building. And when you have a for example, here, this floor is very deep. So it's very good for office. It's very good for studios. It's not very easy to convert it to residential. So there's a lot of hype.
A really nice floor through the apartment, right? I mean, light from both sides.
Right, so when you are close to the window, right, that's great. Here is the problem. Now, when you try to convert it and you have a lot of space that is not usable, what are you going to do with it? So it goes back to, yes, you can convert those buildings, but most of those buildings need some type of incentive, either tax or some type of incentive to help the developers to convert them. And if you really stop for a second and you ask yourself, how many of those buildings are really being converted versus all the talk around it, there are not too many that are doing well.
Speaking of office, in terms of the overall commercial real estate space, I know that you don't do office, but other developers have told us that the weakness from that one space, that there is an impact on the rest of commercial real estate. Do you feel that at all?
So I don't do it for a reason, because I think the residential space, to me, is the most safe kind of a space or sector in real estate. But what we see in the office space is very interesting. The brand new truly Class A office buildings are doing well. Those that are new with all the amenities and the state-of-the-art systems, mechanical systems, those are doing well. But if we look at New York, and not only New York, every major urban city, there's a lot of inventory of what we call B and C type of office buildings. Those struggle a lot. Some of them will need to be converted from one use to another.
But does that weakness there in the possible defaults that could be coming, and just everybody's talking about, you know, extended pretend values, does that impact your area at all? Do you see it pushing out in any way, like on the financing, that sort of?
Right. No, because the residential construction lenders are not, they mostly focus on the residential sector. The same as when we, on our debt side, we focus only on the residential sector. I don't know enough about the office or retail to really make a judgment if one location or one building is better than other. I have a general view. But you know, it's so specific, real estate is so specific, and it's quite sophisticated. I better know what I'm doing before I lend money to somebody.
So much money, yes. Hey, Mickey, before we let you go here, give us your thoughts on South Florida. I know you've got experience there as well. Are we overdone there, or is it still got strength?
So South Florida, let's zero in again, because every market is different. I think Miami is actually doing well. Of course, it's all about the very delicate between inventory and demand. But Miami matured to a point of no return. There's so many great things. This is not only anymore just, okay, I want to be there a couple months during the winter time. I mean, there are amazing restaurants, museums, sports, you know, whatever you want is there. Not to exactly the level of New York City, but very close to it. So the market is doing well. We have a very big project in Miami. This is the 4th sales office that is open for us, and the product is selling well. So what we see over there, we see different buyers than we see in New York City.
And just real quickly, 30 seconds, who's your buyer? Who's your best buyer to walk through the door?
Where?
Yeah, I mean, it's not the Russians, it's not the Chinese.
Right.
Who's a good buyer for you?
Just someone that really wants to buy and really looking for a product in a specific area. And I want them to step in and look at my product. And if they like it, that's 50% of the sale, right? It might be too expensive for them. It might be whatever, not the right size for them. But if they step in and they like the product, it's 50% of the work.
All right, Mickey, thank you so much for joining us. Really appreciate it. Love getting your perspective. Mickey Naftali, Chairman and CEO of Naftali Group, talking about the residential real estate business in Manhattan. Abigail Doolittle, markets reporter for Bloomberg News, also joining us, helping us kind of spend some more time on the real estate business. I find it fascinating, and there's a lot of different pockets I'm learning. Some are doing better than others.
I was going to say, are you interested in luxury apartment buying in the city?
No, Jersey, those days are over. Those days are over. I sold everything I owned, and now safely Scott's down to Jersey.
Yeah, no, that's definitely something.
S&P 500 up 1.7%, NASDAQ up 2.7%. How about that, folks? That's what a little rate cut will do for you. 10-year Treasury, we're looking at 3.73%, up about 3 basis points, but the 2 years yield has come down, so we got a little bit of steepening there. We'll have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, and the Bloomberg News. With this Bloomberg Business Flash, the Dow, the S&P 500 surpassing their record closing levels. Yet about 8 of the 11 major industry groups in the S&P 500, information technology, that's in the lead. Darden Restaurants, best performing individual stock of the S&P 500. The owner of Olive Garden announcing a new delivery partnership with Uber Technologies. Also said sales have continued to improve since July. You just heard Timothy Graff there at State Street saying the Fed made the right move for the economy and investors by cutting 50 basis points yesterday.
People are realizing the Fed is not behind the curve. There is a soft landing in the U.S. economy. It's been in place for about 12 to 18 months, and this offers some insurance that it can continue for, say, the next 6 to 12 months at least.
Right now, the S&P 500, 96 points higher. That's up 1.7%. We're at 5714 on the index. The Dow Jones Industrial Average of 425 points. That's a rise of 1%. We're at 41,927. And the NASDAQ 100 is up 552 points. That is up 2.8%. Some economic data today. Sales of previously owned homes, used homes, dropping last month.
I was going to congratulate you.
No, I gotta say used. I don't know why we say that. Dropping to the lowest level since October 2023. Realtors counting on the Fed interest rate cuts to revive demand. Still, the problem here in the housing market, things are just too expensive. Weekly jobless claims also remaining subdued. Last week's tally of 219,000 initial claims. That's actually the lowest since May. Yeah, we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. These new glasses, they're not working out. They don't fit. They keep falling off my nose.
I'm sorry. They're Warby Parker, right? I recognize the
You
frame.
get what you pay for. I mean, they're 99 bucks.
That's how the kids get their glasses these days.
But I'm not a kid, and I've got a fat head, and they just don't not working.
Well, you can go to the store. Maybe if you try them on in the store, that'd be a bit better.
Didn't have a good experience. This is like the third time. They got all 2 of them, previous pairs, they got the wrong prescription.
I'm sorry. That's tough stuff. It's tough stuff. It's real news here, guys. This is what we bring you. Yeah. Okay.
Nobody
John
cares.
Tucker. I care. Sort of. I'm Alex Steele alongside John Tucker and Paul Sweeney. This is Bloomberg Intelligence. We are live from Interactive Broker Studio right here in Midtown Manhattan. I was in Canada for like a second this week. Paul was nowhere, but Barry Ritholtz was in L.A.
Really?
Oh, yeah. Wow. He was at the Future Proof Summit in L.A., but he is back in New York City. Barry Ritholtz joins us now, host of Masters in Business on Bloomberg Radio, also founder of Ritholtz Wealth Management. Barry, did you do some surfing? Like, how was it?
So I didn't do surfing, but some of my team took surf lessons, and everybody said it was great. The event is we take over 5 hotels and about half a mile of beachfront in Huntington Beach, about an hour and a half south of LA. And the idea was after the pandemic, how do we have a conference that's not boring and not a super spreader event? And the solution was move the entire thing outdoors. And it's a lot of fun.
So what was, future proof? So talk to us about kind of what you guys talked about out there.
So really interesting stuff. We had 4,500 people, about half of whom are registered investment advisors. So wealth managers tend to be longer term. And there were some big name speakers. There were a lot of really interesting people. But the focus is, how do we get better at our jobs? What can we do to level up, to accumulate skills? The question I probably heard more than any other one the entire 4-day event was, how can I weave AI into my practice to be more productive, more efficient, and deliver better service for clients? And, a lot of young people at this event, the younger generation, it's not that they are afraid of technology in any way. They embrace it. This is the generation coming up that their whole lives, technology and the internet have just been part of the fabric of how they do business. And they are all in on AI. It's really fascinating.
So do we know the answer to that question? Like how to use AI to be more efficient and make a better experience for their clients?
So on Sunday afternoon, we have a fintech demo. 7 new startups, each get 7 minutes, and they do like a speed demonstration. And every single one of them had an AI component. So for example, you have a conversation with a client or a meeting or a Zoom call or whatever it is. So the call gets recorded, and in real time, the AI takes notes, organizes it, structures it. And some of the new startups will take that information and put it into whatever your customer relations manager software is, Salesforce, Redtail, Black Diamond, whatever you're using. And it really creates a record that's just so much more efficient and productive than, the last thing you want to do when you're having one of those intimate conversations with someone about, their life plans, who they want to leave their money with when they pass away. You want to be paying attention. You don't want to be scribbling notes. Having technology allow you to be fully present and engaged, it's a big deal. And across from hey, we're going to do separately managed fixed income accounts using intelligence to identify the best separately managed bond portfolio for you based on the state you live, your tax bracket, your income, like all these different variables that you couldn't have done 20 years ago. It would have taken a dozen people weeks to figure it out. They're doing on the fly in real time. It's fascinating stuff.
Hey, Barry, what do you make of today's action in the marketplace? I mean, we got the surprise Fed rate cut yesterday. We got nothing out of the market yesterday in terms of reaction, but somehow people kind of slept on it and said, okay, let's go buy some stuff out there.
So was it a surprise when first off, I think people were 50-50.
Yeah, I think you're right.
For 50? They were 50-50 for 50?
50-50 between 25 and 50, number one. But second, I'm a big fan of what Torsten Slok wrote this morning. The bottom line is that the market narrative at any point in time is almost always wrong. That's a fascinating quote because it just goes to show you nobody knows anything. The expectations are always, either the direction or the magnitude is wrong. I have been saying, you guys have heard me, I'm sure you're tired of hearing me say the Fed is behind the curve. They have to step up. Inflation peaked in June 2022. I'm kind of impressed. I thought they were a little timid as a large institution and afraid of making a big statement. I'm interpreting it as an acknowledgement that, hey, not only are we behind the curve, but 2 other factors. First, the bottom half of the economic strata is suffering from high credit card rates, and the Fed is partially at fault. But second, you were just discussing the housing market. So much of the housing market is locked up because half of mortgage holders have mortgages that are 4%, 5%, and they're stuck in place because they're golden handcuffs. No one wants to give that up. So if the Fed brings rates down to neutral, the problem with real estate is a lack of supply. We're running like 20-25% of the normal listing rates across the country. Some supply comes out. I think that'll ease some of the price pressures, and especially on the first-time home buyers. They're really struggling.
Interesting. I think for me, rates would have to go down a lot more to get rid of my golden handcuffs.
Really?
Oh, yeah.
But a 4 handle, that's historically low if you had to move.
If I'm making the same amount of money I'm making now, not good enough.
Not good enough, okay.
No.
Well, if you're at a 2.75 or a 3, you're not going anywhere.
I'm 2.75, Barry. I'm 2.75.
All right, so you're there. But if you're at a 4.5, and you just had your 4th kid, and you want to move to a better school district, and you're busting at the seams,
sure.
7% doesn't get you there. But high 5s, all right, we got to get the heck out of here. Let's start looking.
No, that's a fair point. Ooh, 4 kids. Okay, Paul knows what that's like.
I know.
He does. All right, Barry, thanks a lot. We appreciate it, Barry Ritholtz, joining us. Ritholtz Wealth Management, and also host of Masters in Business. You can check all of that fabulous stuff out on his website, plus Bloomberg.com. All right, coming up, JetBlue is trying to do some premium luxury stuff. Did you see this?
I did not see that.
What is that? mean? What does that look like? I'm not a JetBlue person either, but George
People like
is.
it.
Yeah, no, people definitely like it. George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst, joins us next to talk about JetBlue's push into premium, looking at markets continuing their rally. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, everybody. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. It is Hispanic Heritage Month, and every day at this time, we are celebrating significant moments in Hispanic heritage. And now with your installment for September 19th, here's Bloomberg's Lisa Mateo.
And this is a significant moment for sure. On this day in 1985, it was a powerful magnitude 8.0 earthquake that struck off the coast of the Mexican state Michoacan. Now it caused widespread death, injuries, catastrophic damage in the Mexico City area. A second tremor, nearly equal magnitude, occurred the following evening. Then President Miguel de la Madrid, he and the ruling Revolutionary Party, they were criticized for what was thought of as an insufficient response to the emergency, including an initial refusal of foreign aid. Now in 2017, that very same day, the greater Mexico City area, it took another powerful hit. A magnitude 7.1 earthquake struck just south of the city of Puebla, Mexico. That's Today in Hispanic Heritage. I'm Lisa Mateo, Bloomberg Radio.
All right, Lisa, thank you so much. We appreciate that. I don't know. I'm a Newark person. I've always been a Newark Airport person, so that means I'm a United person. They know me by name over there. But JetBlue, They're making some moves here, and I love, JetBlue customers love JetBlue by and large.
It's true,
It's
they
really
do.
got a good.
My daughter loves JetBlue.
Oh, she does.
It's a TV.
Oh, it's a TV.
Yeah.
Okay, very good. But they're making some moves here, opening lounges and doing all that kind of stuff here, maybe making a little bit of a premium push. George Ferguson, he joins us. He's a senior aerospace and airlines analyst for Bloomberg Intelligence. So you were seeing some reporting, George, that JetBlue was opening lounges at JFK in Boston, trying to get into that premium market. What do you make of it?
Yeah, so yes, they're trying to get deeper into that premium market. They have the Mint product, which is a premium product. Clear to me that their customers must have been telling them, it's really great. I get on the airplane and I have, great surroundings on the airplane, but before I get there, I want to be in a more comfortable environment. And so they look at the lounges. Interesting, they're going to start with Boston and Kennedy, probably some of their sort of higher business premium travel centers, focus cities for them. They said later they'd look at Fort Lauderdale, Orlando. My guess is that they're not as big of a draw, much more of a leisure crowd going through there. JetBlue really, right here, kind of in the middle ground, a really hard middle ground, I think, for airlines right now, because there's so much of their business that's economy type business, but they can't deliver seat miles as cheap as Frontier, Spirit Airlines. So they got to go find a place where they can get, do less volume at a higher price point, and that's going to be premium. But they grew up as a low-cost carrier, so they're trying to migrate up the curve to be more of a full-service carrier.
Well, that's what I was wondering, whose customers, George, are they trying to snag with this kind of thing?
I think they're going to, I think they're trying to keep some of their own customers. I mean, the problem I still have with JetBlue is that if you're a business customer and you need to be able to go globally on an airline, like Paul, maybe you're going to Newark and taking United because JetBlue just can't get you that many places, right? It gets you really good East Coast, Caribbean, some transcontinental, but it really lacks a lot of the markets you need for business. So I think of them really as a high-end leisure traveler out of the New York area, a bit of a business traveler out of maybe New York and Boston, but it's really a very leisure-driven airline.
So, but that's not such a bad thing, is it, George?
As long as you still travel.
Yeah, true.
Yeah, I mean, no, leisure has its place, right? But I think there's less leisure high-end travelers than there are high-end business travelers. And so I think if you want to be high-end full service, you got to go find that business traveler. And it's hard when you don't have the cities,
Well, how much is it going to cost them to kind of put in this premium thing right now?
I mean, honestly, I don't have that sort of on me. Those lounges, I don't know, you end up having to buy some space, caterers, things like that. I don't think it's going to be super expensive, but it again adds to the cost base of the airline that they have to bear, and they got to run leisure travelers through those lounges, have them be willing to pay up for that experience.
This is going to be tough for me on Friday night. I'm going over to Ireland. It's going to be my first European trip where I haven't flown first class or business class in like forever. 25 years. And
you didn't fork up for business?
No, it's like a 3x kind of multiple there, 4x kind of multiple. It's crazy. Little Tylenol PM, I'll be fine. George, 30 seconds. Give me the update on Boeing. Any reason to be optimistic here?
So not hearing anything. They're furloughing. They're talking about cutting supplier deliveries. I don't think Boeing has a lot of time. I think they got to come to an agreement here soon. So, but right now, I'm not hearing anything that tells me this is almost.
I mean, just looking at it from outside, it seems like labor really has the leverage here.
Yeah,
like not even close.
Yeah, I mean, I see machinists out in Wichita negotiating as well, and they're looking. The offers are like 26% increase from Textron. They'll probably get Textron for more than that. So, how do you give 26% to the Pacific Northwest, sitting with all those tech companies? It's hard.
Yep. All right, George, thanks so much. Appreciate it. George Ferguson, Senior Aerospace, Defense, and Airlines Analyst for Bloomberg Intelligence, giving us an update. JetBlue trying to get a little bit of premium and getting the latest on Boeing. I just, looking through George's research, you have to have the cash flow, which means you have to deliver planes, which means you have to get the workers back. You just got to bite the bullet. If I were Boeing, I'd say, you know what, guys, bite the bullet. Let's get this deal done. I'll try to get back to these labor guys later, in 4 or 5 years.
Yeah,
But
but
right
I
now,
mean,
I gotta go.
as you're pointing out, moving the manufacturing from the West Coast was like a nail in its coffin.
They moved their leadership. They still
the
make
leadership,
they
that's
still
right.
make
The
the plane.
leadership, but the manufacturing was somewhere else.
But the line worker said, my leadership just left. What's that commitment to me?
Right. That's such a good point.
That's kind of how I thought about it.
All right, well, that wraps it up for me and Paul. Who's going to go pack now for Ireland? We'll be back tomorrow. Yeah. All right, Balance of Power will be up next with Joe Matthew. Happy Thursday. This is Bloomberg.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
New polls show Kamala Harris catching up with Donald Trump on the issue that will decide the election. Welcome to the fastest show in politics now, with 3 major polls out painting the same picture on the issue of the economy. This hits as Harris heads for the swing state of Michigan today, only 2 days after Donald Trump stumped in Flint. And we'll get the lay of the land in Michigan from Nancy Kaffer, the editorial page editor at the Detroit Free Press. The stopgap bill we told you about to fund the government in the Republican-led House failed as expected. We'll have the latest for you on Capitol Hill with analysis from our political panel now, with 12 days to shut down. RNC former communications director Lisa Camuso Miller is with us alongside Adam Hodge at Bully Pulpit. A lot to get to today, and we start, as always, on Wall Street rally time this day after the Fed with Charlie Pellet. Hey, Charlie.
Well, hello there. More green than St. Patrick's Day today. On track for our 39th record of the year on the S&P 500 index. Big upside gains right now. Right to the numbers. Here's where we stand. S&P up 93. That is an advance now of 1.7%. Dow Industrials up 435, up by 1%. And NASDAQ surging 461 points. Risk on here with NASDAQ up 2.6%. NASDAQ 100 index up 2.7%. Russell 2000 ripping higher as well, up now by 1.7%. Traders are betting that the Fed will be able to engineer a soft landing, and they are spurring a rally in riskier corners of the market. Stocks hitting records. 10-year at 3.73%. We do have the 2-year 3.60%. Spot gold advancing 1.1%. 25.88 the ounce, looking at a record for gold. And West Texas Intermediate crude now up almost 2%, up 1.9%. 72.25 for a barrel of WTI. While stocks are ripping higher, there are reasons for concern, according to Gargi Chowdhury, the head of iShares at BlackRock.
I think for equity markets, this is a seasonally weak period. We're going to have a couple of risk events. We're obviously going to have the election in 6 weeks or so. But more importantly, before that, we're going to have earnings season. And I think it could maybe make sense for equities to pull back just a little bit. I don't think you're supposed to step away.
Chowdhury was interviewed on Bloomberg Surveillance, and you can hear more of the conversation on the Surveillance podcast. Download it wherever you get your podcasts. Briefly, Apple has been warned by the European Union to open up its highly guarded iPhone and iPad operating systems to rival technologies. And Amazon is launching an artificially intelligent assistant designed to help online merchants manage their businesses. Recapping stocks higher the day after the Fed. S&P right now up 1.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. Balance of Power continues. Back we go to Washington. And once again, your host, here he is, Joe Matthew.
All right, Charlie Pellet, what a report. This is a day. And we'll get back to Charlie on the markets a little bit later on this hour as we chart our course on this little Friday. Yes, welcome to the Thursday edition of Balance of Power. I'm Joe Matthew in Washington. With much going on today, Joe Biden is talking to the Economic Club of Washington a little over an hour from now. We'll get there. We'll bring an ear on that speech and walk you into the room to see if we hear any news. As we follow the candidates themselves, Donald Trump resting up after a big night, Long Island, with a big night in the Coliseum. And Kamala Harris today heading from Michigan, back to the swing state of Michigan, the state that may well decide this election on the issue that is expected to decide this election. That's the economy. And so reach under your seat right now. Reach under your seat. Make sure there isn't a free car under there. Yes, she's appearing with Oprah. I make not reference, of course, to the many tax exemptions that we've heard from both campaigns, but no, Oprah is going to be holding forth in what's described as a virtual campaign event with Kamala Harris, and they are doing it not by accident from Michigan. That'll happen tonight, 8:45 p.m., I believe. Do I have that right? We'll get that for you in just a second. 8 p.m., forgive me, the virtual event with Oprah. And yes, that's right, CC, you get a vote, and you get a vote. I mention all of this on a day that we get a lot of new polling here. And this is interesting because it comes after the Quinnipiac poll yesterday that showed Kamala Harris catching up to, if not passing, Donald Trump in what was really a statistical tie in the three swing states that matter: Michigan, Pennsylvania, Wisconsin. Here we go. New York Times, Siena, Pennsylvania, Kamala Harris 50, Trump 46. Marist out with new statewide polls on those three. Harris leading Trump in Michigan, 52 to 47. In Wisconsin, 50 to 49. In Pennsylvania, they're tied at 49. Within the margin here, certainly. And I want to add one more from Morning Consult. 46% of voters, this might be the most important number that we hear today, say they trust Kamala Harris to handle the economy. The same share as Trump. That number was 41% when Joe Biden was in the race. And yeah, I'll add one more log to the fire. Financial Times, University of Michigan Ross School, Harris a slight edge over Trump when it comes to the economy. Now remember, we're coming off the Fed meeting yesterday. The wealth effect, the psychological effect of this market rally, you put this all together, and I can't wait to see what the Bloomberg swing state poll says, because we're in the field right now on this one, not just post-debate, but post-Fed. And for our audience here at Bloomberg, that is, of course, extremely important. Now, as we consider where we are here in the grand scheme, a conversation that we had promised you on Balance of Power, live from Washington with an eye, of course, on Michigan. Nancy Kaffer is the editorial page editor at the Detroit Free Press, and back with us on the program. Nancy, it's great to see you. Sorry for the shower of numbers, but we live for this stuff, and when it comes to the economy, we have seen a pretty remarkable turn, and I wonder if you're feeling that on the ground or hearing that from people in the swing state of Michigan.
There's just, instantly when the ticket switched, there was a huge surge of excitement around Harris's candidacy that just hadn't been there for Biden. And the question, of course, was, would she be able to sustain and build on that over from the time of July till the election? The big advantage here is that it's a pretty short amount of time to kind of keep something going. But we're starting to see some movement in the polls. I would say that after 2016, I kind of got out of the business of making predictions about what's going to happen here. And if anyone tells you they know, don't believe anything they say. It is going to be close here. But the polls are definitely, our last poll prior to the debate had her up by 1 point, which is a big shift from, I think our last poll with Biden on the ticket had him down by an astounding 13 points. So we're starting to see some movement. You mentioned some of those polls that show her with a substantial lead outside the margin of error. Either, this game better than I do. She's either we're going to start to see more polls showing that result, or we'll find out those polls were outliers, but we're going to learn a lot. We got a very short amount of time here.
We do. It's a short window, but I have to admit, we're starting to find some continuity in these polls here, at least in terms of direction. I think we can both admit here, but I want to know more about what's happening in Michigan, because there were pockets of the progressive Democratic base very upset with Joe Biden, and it had a lot to do with Israel. I don't know if Arab American voters in Michigan have changed their tune on this, but this is a big deal for Democrats right now, particularly as we see Israel potentially open a new front to the north with Hezbollah. We're going to talk more about that later on this hour, but there was a real protest vote in Michigan. Nancy, what about now?
So there was, and I think it's important to understand that the Arab American vote was only a portion of that. There was a large portion of uncommitted. There are 100,000 uncommitted votes in Michigan in the presidential primary, which doesn't sound like a lot of votes until you remember that Trump won the state by about 11,000 votes in 2016, and Biden won by about 150,000 votes in 2020. So 100,000 votes, while it might not be a significant percentage, I'm a lot more interested in raw numbers right now, given the last two cycles. So we saw that uncommitted vote, not just in Wayne County, where the Arab American population is centered, or in Oakland County, where there's still a significant population, but smaller. We saw it in Washtenaw County, where University of Michigan is. So there's a big college community there. We saw it in counties actually across the state where there isn't a significant Arab American population and where there isn't like a large progressive campus population. So that is fascinating to me. And I think there's a lot of tension and indecision in the community about what the best thing to do this fall is in the Arab American community specifically. There's no one I've talked to really believes that Trump is going to be better on Gaza. This is what the folks are concerned about, is the humanitarian crisis in Gaza and civilian deaths. I don't think anyone thinks Trump is going to be better on that, but there's a hard stop for people who feel that Harris has been complicit in an administration that hasn't done anything to stop or put conditions on the use of arms sales, or was kind of late calling for a ceasefire. And for some folks, it's just kind of a moral hurdle that they're struggling to get past. And I think there's a lot of real genuine conflict and angst in that community. And I don't know how that's going to sort out.
Well, that's a very thoughtful answer, which makes me think that this is still a very real story here. I wonder if it's something that Kamala Harris talks about in her virtual event later, because yes, Oprah is coming to town, and I'm curious about the Oprah effect, if there is one. Nancy, remember the impact that she had on Barack Obama's campaign, but there's new polling out from Monmouth University, and I'm guessing no one's going to stop down to talk about this today, other than yours truly. Just over half of American voters, 53%, approve of Taylor Swift getting involved in this campaign and encouraging her fans to vote in the upcoming election. That means a lot of Americans don't, and we're seeing a pretty steady decline among independent and Republican, not a surprise, voters in their impression of Taylor Swift encouraging her fans to vote. Does Oprah help in Michigan?
So, yeah, Oprah's very popular. You might have heard that. The thing is, when you look at where these candidates are coming, right? You've got Harris and Walz have typically been coming to Metro Detroit area, which is a huge, the Democratic stronghold. Wayne County is one of the most Democratic counties in America. Oakland County has become much more Democratic. It used to be a Republican stronghold. For those of your listeners who don't have an encyclopedic knowledge of Michigan counties, it's a more affluent, more educated county. It's been trending blue. Washtenaw County, where Ann Arbor and the University of Michigan are, obviously much more Democratic and progressive. So the Democrats have been concentrating their attention in this area. The Republicans have been coming to more rural, more outstate places. So these guys know where their votes are, right? And there's roughly, Michigan is roughly split, and this is a turnout game. This is who can get people out to the polls. And I think you see that in what they're doing and where they're coming. And so Detroit is a very Democratic city, like 98% Democrat.